You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. Before we move on, I really want to tell you about a great sponsor that's joined us for the show. Private lenders, this one's for you. If you're not currently automating your internal operations, you're likely spending a lot of time on tedious manual processes. If increasing efficiency and generating more business is your company's goal, automation is the answer. Recently featured in Forbes and Entrepreneur Magazine, Mortgage Automator is a complete loan origination and servicing platform designed specifically to optimize your processes and automate your tasks, including all of your communication with the various parties involved in your transactions. It can help you generate and send off documents, such as term sheets, in seconds for digital signing. It's also able to handle your payments, collections, accounting, and so much more. Focus your team on growth and let Mortgage Automator handle the rest. Go to mortgageautomator.com to book your personal demo and find out how Mortgage Automator can help your business grow. Hey guys, Kevin Kim here for a new episode of Lender Lounge with yours truly, Kevin Kim. Today I have my friends and longtime clients, Enact Partners. Mike, welcome. Chris, welcome. You guys drove all the way up from Carlsbad.
Carlsbad, yeah.
So we're in Drosy headquarters today. We never get to do this, so I'm really happy that we're able to do it in the office. So thank you for coming up. About an hour, 2-hour drive. So
thanks for having us.
It's not an easy one. Thank you for coming.
Yeah.
So let us know, let our audience know, think about, tell us who you guys are and tell us about the company first, and then we'll get into it.
Okay.
Yeah.
So why don't you start, Chris? Tell them who you are, and then I'll...
Okay, so my name is Chris. I'm the new guy at Enact Partners, came over in March. I have kind of a varied background. I started as an engineer doing construction engineering. Then I started my own contracting company in 2007, which didn't work out so well, and kind of could do anything I wanted at that point. So I decided to join the Marine Corps, where I was a communications officer for 4 years. Did a stint in Afghanistan, which is kind of frustrating to see what's going on right now.
Yeah, it's fresh in your mind right now, I'm sure.
Yeah, exactly. Yeah. So from there, I worked on an evening MBA program while I was still in the Marines, and through that, I got a job at Torrey Pines Bank, which is part of Western Alliance.
Very cool.
I wanted to get into real estate, and I got a job doing underwriting in their CRE group. And after 9 years, I was introduced to Michael, and he had an opportunity to come over to this smaller group, smaller team, which is what I really wanted to do, and came over in March, and it's been going really, really well.
All right.
Excited about it.
Yeah. All right, Mike. We got to hear the story.
We're excited. We're excited to have Chris on board. He's been a great addition to our team. My name is Michael Schumacher. I'm the president and founder of Enact Partners.
Mm-hmm.
You and I have known each other a long time. Drosy's been instrumental in getting our fund going.
We've been working
us
together since 16 now?
16 or 17. Yeah. So, the fund, you guys put our fund together. Obviously, you guys help us out with loan documents, website, media, all kinds of things.
But tell me, because you guys have a very unique kind of focus as a private lender, right? Enact, you guys do a lot of construction.
We do. Mm-hmm.
And you guys both have... Because you tell me a construction background, but you also have a construction background, right? Or more of a builder background, commercial real estate background.
Yeah,
right?
My background has really been, the first 15 years of my career was in commercial real estate development. Right. So building office buildings, industrial, retail, environmental mitigation banks, if you know what those are, historic rehab. So that's really where I started. My career is on the private side, going to public agencies and getting the approvals and entitlements and things like that, and then building the office buildings.
And then, so Enact was founded in?
Well, we really started doing loans in 2013. Enact was founded in 2009, but we started doing loans almost by accident in 2013, and then just loved it, kind of fell in love with it, and did it really more, started doing loans really personally. And did one, and then did two, and then did three, and investors, right, exactly, yeah. And investors, they liked it as well, and it just kind of grew organically from there.
So today, It's 2021. Enact Partners. What's the kind of like credit box and product offering to the industry look like?
Yeah, so we do, as you said, we do a lot of construction. We do land, depending on where they are in their entitlements.
No raw land though, right?
No, generally not. It depends on what it is. Like we did a loan on an apple orchard, right? And it's a business.
Ag loans too.
Yeah. So we'll do an ag loan. I mean, it's got to make sense. It's got to be a really low loan to value. It's got to be a really good sponsor.
Right.
Last week we closed an $8.5 million loan on a Napa wine production facility. So they're not a winery per se. They have grapes and they grow them, but they're really producing. They're doing the fulfillment for crushing and storage.
You're
and stuff
underwriting
like that.
processing plant more than anything else.
Well, we're really using the real estate as like if we have to take this property back, like what is the value and can we sell it, with the business or without the business? So,
Very cool. And is it mostly commercial, or are you guys also on the resi side?
No, we're mostly commercial. We don't do any owner-occ stuff. We do have some residential. We're going to close this week a couple condos downtown San Francisco. We've got a downtown San Diego condo.
Investment properties.
A single-family house. Some small stuff like that. We like the residential side, but we don't find ourselves really being competitive in that space. There's so many. That's a crowded field.
It's a very crowded field.
Right. And so with our background, Chris's background in construction and development, my background in construction and development, that's the space that we like. Obviously, we're not a high volume operation. We're, very
You guys
picky.
are a boutique shop, definitely, but you guys have kind of built a reputation around being able to do a lot of the deals that, our average private lender client who's, doing your fix and flip deal can't touch. But then you're also able to do the deals that what I would consider like, your kind of like mid to small balance commercial bridge shops, they can't do it, right? You're kind of like, you're able to be a little more nimble in that context, being a boutique shop. Now tell me about this. So when you guys started back in 2009, you said, were you guys a developer back then? What's the story of Enact, when you were founded and when you transitioned to being a lender? Yeah.
So I started doing, real estate development basically right out of college, went back and got my master's in finance, tax increment financing, which is the cruel irony is I live in one of the only states that doesn't allow it anymore, right? After 2009. But, and then during the Great Recession, during the downturn, I was hired on by a large, private national retail developer, basically fix their broken projects, right, in 2008, 2009. So I was the guy that was flying around and fixing their projects. I would do whatever I could. I'd go to Fort Worth, Texas. I'd put in the wet and dry utilities. I'd build the roads, the retaining walls, and we would get rid of the properties any way we could. We'd do a build-to-suit, a reverse build-to-suit, a ground lease. We'd sell it. We'd do whatever we could. And so I reported to that company and also their equity partner out of the East Coast. And so, every week I was flying around and I was kind of the fix-it guy, which has actually been really good for me because, markets are very cyclical, right? And we are where we are at a very high point in our market today.
Right.
That's not going to stay forever. And so having that workout experience.
That's workout experience. You're actually resolving a lot of construction issues that most lenders don't know what to do with when they're on paper, like, okay, well, this needs to be fixed. Contractor, go fix it. But what you're telling me is that you guys are going to be able to, the way they're doing it, you can evaluate whether that's a sound method, right? Whatever they're doing to continue the project or get it get it off its back essentially,
Right.
and fix the problems. You guys actually understand what those specific things are. Like someone in my position, I would have no idea what retaining walls or engineering. What does that mean, right?
Right.
But when you're taking a troubled project and you're trying to fix that, as a lender, that's a huge asset to have in your toolkit. I mean, a lot of us don't really. I mean, some of us who came from the building world probably do, but like a lot of our listeners are, they've been originators their whole life, and this kind of stuff is foreign to them. So that's very cool. So you were working for a national retail developer, and then when did you break off on your own?
So in 2013, a friend of mine told me about these first trust deeds, right? And said, just for our personal, investments. And so I did one. I called up a buddy of mine and said, "Hey, I'm going to do one of these deals." And I'm going to go in a little money. You want to go in a little money? By the way, I've never done this before in my life, And he said,
What kind
sure.
of deal? What kind of deal was it? What kind of deal
It was a $100,000 loan on a property in Temecula, California.
Okay.
And it was on 18 acres of land, and it had a really nice manufactured home on it. And lenders just weren't lending on manufactured homes, or they didn't give any credit for land.
Didn't exist. Yeah.
It was a father-son business that they needed to raise $100,000
Cash
for.
out
They
refi?
owned it. Yeah, it was cash out refi. It was, it appraised for, I don't know, $280,000 or something like that. So it was a low loan to value. It worked great. It was perfect. So I did one loan, went in $50,000 with my buddy, and, we each went in. I said, look, I've never done this before, so I have no idea how it's going to go out. But, I was in the real estate space, so.
Yeah. You understand how to read an appraisal.
Yeah.
Yeah.
Right. So we did it, and then and that went well. And then I moved on to do another one. He said, hey, I've got a buddy that would like to do the same thing. Do you mind if we? And I said, well, I got one too, so we got to make room for more people. And then we did a third one, and then a fourth one, and it's just sort of.
So you really started as a trusted investor.
Yeah.
It's interesting. So you were a real estate developer, construction specialist, having that background, and doing this as an investment while you're working still, as these retail the Mr. Fix-It for these retail projects. So when did you oh wow, there's a business here. Let's jump all in and kind of convert the model?
I was probably the fourth or fifth deal. I was still thinking about it as something that I was just doing, on the side.
And this is 13, 14?
Yeah, 13, 14.
Well, the industry was so different in 13 to 14.
Yeah, I mean, the institutional money really wasn't there.
And rates are still 12%, 10, 12%, right?
Yeah.
I miss those days.
Yeah, those were good days. I do too.
Yeah. So were you working just in California at the time? Just doing deals here in California?
For the loans you're talking about?
Yeah.
Mostly California.
Okay.
We've done stuff in Washington.
Right.
Colorado.
Now you guys are in multiple states.
Yeah.
But back then, when you jumped in 14, it's kind of interesting because, we meet people today who are just learning about this stuff, right? And they're starting to make their first trusted investment as a lender, or they've been, lending on friends and family deals. Now they're doing kind of their first loan as a professional lender. And when we find people who entered the space like you did, right, which is very, very rare, in my opinion. We see a lot of folks come in either from Wall Street these days, or coming in from I've been a mortgage originator my entire life, setting up shop somewhere else, doing my own thing, right? So you come in as an investor and a builder, essentially. And, for the folks that are just jumping in now, when the market is so different, take us back, what was the average LTV back then for deals? 50s, 40s, right? I mean, you were doing 10 and 2, 12 and 2, right?
Yeah.
Was it construction back then too?
We didn't start construction for a little while. I mean, we did kind of more mainstream stuff in the beginning.
Fix and flip.
Yeah, because I didn't want to take it on as a project if there was going to be a problem.
Right.
So we did pretty basic stuff in the beginning, but as our deals got bigger, you can't do multi-benny anymore. Now we started creating LLCs. And so we had, at one time we had 15 different LLCs that we were managing. That's a lot. And it's almost impossible to scale a business if you're creating a new LLC, for a $4 million, $5 million loan.
Right.
So that's when we came to you guys, and you guys helped us out with the fund.
But what's interesting is you're taking a $4 million loan, but this is you're progressing, but most people don't transition from we're doing cash out refis on resi deals that banks won't touch to $4 or $5 million commercial deals. It's a big transition. Does that have to do with your background? Is that why your career before this?
Yeah,
I understand this better.
I think so, and I would say this is still true for us today. For whatever reason, the smaller loans, the smaller deals, seem to be so much more work than the bigger deals. Because typically, when you have a large project, you've got the A team. You've got, a sophisticated general contractor, a sophisticated developer. They've got financial resources. They know what they're doing. Right. When you have these smaller, they're well insured, exactly. And when you have these smaller loans where it's kind of mom and pop a little bit, it takes a lot of, hand holding. So you spend
That's a different
lot
perspective,
of time.
because I see this same perspective, but given to me in the context of the lender's business, right? The lenders are more sophisticated and their staff are more sophisticated, but you're looking at it from the borrower's build team. Well, that's a very good place to look, because a lot of that's never really discussed. We never really talk about the quality of the contractor, the quality of the developer, quality of the architect, quality of the engineers. We don't talk about that much on the show, because while everyone is doing construction, I think it's kind of something that's overlooked. We're always obsessed with values on this show for some reason. We're talking about valuation a lot. I want to ask you though. So you were so first of all, thank you for your service. Thank you very much for your service. But okay, so you're in construction, Marine. Banker, And we have the same job. So you were an underwriter at a commercial on the commercial real estate team, right?
Right, 9 years. Yeah.
I did that. Banker's hours must have been good. And now you're transitioning into private lending. I mean, you go from fast-paced, bank hours, and back to fast-paced. You like the fast-paced life a little better than bank hours? What do you think?
I do.
Yeah?
I do. You know, I told Michael when we were talking about me coming over, when I was in the Marine Corps, I didn't have to have an alarm. Like, I woke up every day, just jumped out of bed, ready to go to work, excited about it.
Right.
And no offense to banking or Torrey Pines, but it just wasn't the same thing. And by the way, I really had a great time at Torrey Pines. It's a great bank.
That family of banks is very entrepreneurial, so it's a little different.
Yes.
But like at most banks, man, it is boring as hell. Right. You wake up at 9, and you get to work at 9, and you do the same file over and over and over again. Because most banks do the same loan over and over and over again.
Right. Well, and that was a great advantage that I had at Torrey Pines because we do so much different stuff. I mean, I was doing term loans on medical office all the way to A&D, acquisition development, land loans, doing big single family spec projects and everything in between. So it was a great learning experience for me to come over to Enact Partners where we basically do anything under the sun as long as it's business purpose. I've experienced in all of that. So it really was great.
And you have the construction background, which is huge for you, a necessity for your team. Mm-hmm. And this raises an interesting question is, how shocked were you? I always ask recovering bankers for this. When you transitioned into private lending, right, had you had any experience with how we underwrite, evaluate, and move? Right, because it's a totally different way of doing things.
It is. It's totally different.
Right. The idea of a credit committee is kind of lost on us, except for unless you're big and fancy from Wall Street. But like the idea of a credit committee, you are a credit committee.
Right. Credit committee right here.
Yeah.
Yep.
So, but there's some beauty in that efficiency, right, and that speed, and that. But like, how much of a change was that for you? Give us a I guess. When you saw this, your first file, right?
Right. Well, yeah, it's been huge. I mean, like you said, Michael and I are the credit committee. We get to make decisions. We can make decisions in a day.
Right.
Whereas in banking, that's not the case. You might have to go through 4 or 5 levels of approval. I mean, it could take 2 to 3 weeks just to get a term sheet out. And by then, you've lost the customer. So
right.
I really do like that about this space is you can make decisions and just act on it and move.
Mm-hmm. Mm-hmm. And let me ask you this: when it comes to the borrowers, though, because we're talking about the quality of the borrower, because you guys are known for doing larger loans. You guys don't do the $100,000, $200,000 loans. You're typically doing anything between 1 and 10, right?
Yeah, I mean, we'll do $500,000 loans.
Yeah.
We don't do a lot under $500,000. We would if it's the right deal, but that's not really our market.
Your sweet spot's probably the 1 to 10 mark.
Yeah.
Yeah, and so when you're dealing with a higher quality borrower, but still having to make sure, because I feel like the even in commercial, the borrowers are now used to private lending. They understand and have a certain expectation, right? And being a boutique shop, like tell me about when you guys take on your borrower process, like when you guys are working with a borrower, how does that look like? Because you said you guys can make a decision in a day, and then that leads to probably funding within a week or two. And then what does that look like for you guys?
Well, that depends on the situation.
Sure.
If
average deal, nothing crazy. Yeah.
Yeah, I mean, typically we would need to get an appraisal, especially if we're talking about a construction project. So really our closing depends on the appraisal. Mm-hmm. We do have some instances where we didn't require an appraisal for various reasons. It was a very simple property, and in that case we can close in 2 weeks, let's say. But like you said earlier, I mean, it's a lot about looking at the developer and developing a trust. Mm-hmm. Zoom has helped a lot with that because we can quickly just have a meeting face-to-face, air quotes, with the developer.
Than local.
It is. It really makes a big difference. And you just get a good feel for their experience and how much they have thought through the project. Like you said earlier, we look at the contractor, architect, make sure they have a good team. And if we get a good feel for the team, then we can move forward.
Let me ask you this. How do you guys evaluate those team members? I've actually always wondered this. Like, how do you really evaluate the quality of a contractor and his team and, a developer or an engineer? Like, what are you guys looking for? Because we're in our space, we're having to move quick. A lot of it comes to reputation, I'm sure. But what other things are you guys looking for when you evaluate that team?
Usually what I look at is the website, to be honest, and look at their former projects. Mm. And if their former projects are similar to what we're doing now, mm-hmm. and they look good, and
track record,
exactly.
Same thing with lenders too, right? I mean,
And we'll go on site and meet with the contractor. We'll go into the construction trailer, look at the Gantt chart, schedules on the wall, go through the whole thing, and you can tell. I mean, you can if they don't have a construction trailer, that's
you go on site and these
flag.
they're set up like a legitimate shop. Yeah. Okay. And on the insurance side, is there anything specific that you guys require? Because this is a different thing. This is a whole different world to me. I don't understand this world, and this makes me curious. When it comes to these types of projects, like how does the insurance and the bond process look like, and requirements look like for you guys?
Well, there's a couple levels, right? There's the sort of hazard insurance, right?
Sure.
We make sure that they have course of construction, builder's risk, right? We want to make sure that if a supplier delivers a bunch of 2x4s to the site and those things are stolen, that we're held a beneficiary for those
which happens
proceeds.
these days, right?
It absolutely happens for sure. So, and we're looking at the security, where they storing their materials and that kind of stuff. So course of construction, builder's risk, that kind of thing. As far as title insurance is concerned, we're doing, periodic kind of date downs to make sure there's no liens that are, getting all lien releases, going through that normal, draw process.
Are you requiring any specific insurance from the developer or the contractors besides their usual,
Yeah, there's several different endorsements that we require the borrower to provide.
Okay.
But we have a much more hands-on relationship with our title insurance companies, right, along the way, versus a regular non-construction project. You don't really see them ever after the closing until unless there's an issue. Yeah.
And what are your guys' thoughts on like kind of how much the market has now adopted construction? And it's more on the resi side than on the commercial real estate side, but like even 3 years ago, finding a lender that would do a construction loan was pretty kind of rare. Today, everyone and their mom does it, and primarily because Wall Street started buying this stuff, right, on the resi side, then primarily. But like, what are your thoughts on that kind of stuff? It's challenging to be, it creates a lot more competitive nature in the market. But like, I venture a guess that the quality and the evaluation of the builder team, that kind of stuff is not happening. What are you guys' thoughts on that?
Well, the market has definitely shifted, right? That old adage of you kind of get what you pay for is a little different today. It's you kind of get what you get and you pay what you pay, right? So the yields used to be much higher, and the risks appear to be lower, right? You have lower loan to values, like you said earlier. Today, we're seeing lenders that are lending at 100% purchase and 85%. Or 85% purchase at 100% of the construction. That's just, we lose out on those deals, and that's okay. That's just not our space.
Right.
So there are a lot of people doing construction, and as long as we've got the wind at our backs, everything's going to be fine. But our focus is to be here, throughout the next downturn, whenever that comes, and we want to survive it. And I think there's going to be some people that are, going to find themselves in a little bit of trouble, especially on construction projects.
Let's talk about that, because there's both on the commercial and on the resi side, kind of, COVID was a good indicator of kind of where the weaknesses are, right? And we're starting to see the same. It's kind of funny because we're barely out of it. We're now it's today. It's September in 2021. By the time this episode airs, it'll probably be in October. But the thing is, like, we're at the tail end of 2021. We're still in the pandemic, but 2020 taught us an issue of liquidity, of capital partners, taught us a challenge of what do you call it, raw materials and these things. But we're starting to see the same risks being taken, I think, from a construction standpoint, especially construction lenders, at least. Where do you see the gaps in the market and opportunities for Enact, in the next few years as things kind of taper off or correct, if you will, for you guys to kind of capitalize?
So for us, we're focused on the western third of the United States, but candidly, we don't spend every loan in our fund. We have some loans outside of our fund still, but every loan in our fund is in California, and it's because we're here, and it's California, but it's hyper competitive, right? But there's a lot of underserved markets out there. There's parts of Idaho, the Wyoming, the Midwest that I think there's opportunity, and they just simply don't. There's not a market. There's a market, but there's really nobody there. So that's
we're starting to see some attention to Ohio and some of the Midwestern states. It's kind of interesting, actually. We're starting to see some companies push out there.
And so that's where I see the opportunity. I think that we're going to start to push out a little bit more and be more active about getting loans in other states. It's, recently it's been more of just, hey, there's a nice deal in Montana, and we look at it and we like it and we like the borrower and we're going to do it. But not really being deliberate about it. And that's something that we're going to, we're actually starting to push out a little bit more.
So you're expanding into other markets, but let me ask you this. So until now, have you guys relied on what I consider like the institutional capital providers or Wall Street aggregators to aid in the business? You guys sell loans? Are you guys working on? I think you have a credit line with a bank, but besides that, like in the fund, but have you been that reliant on Wall Street at all?
Not at all.
Not at all.
No.
Not a one.
Not one.
Wow.
Yeah.
Wow.
Yeah.
That must be temptation to say. It's hard to say no to that temptation. I mean, it's pretty easy to get on board with those guys these days.
Well, the temptation is there for sure.
Yeah.
I mean, what we saw, we're definitely a Main Street lender, not a Wall Street lender.
Right.
And what we saw, during the downturn, our phone was ringing off the hook. Not the downturn actually, but after March 2020, COVID.
Yeah.
Things got a little scary.
What were things like? March hits.
Yeah.
There was those 2 days in March where everyone was just kind of like, oh crap.
Yeah. Right.
I remember calling you. I remember calling a few other clients, and it was funny because I represent mostly balance sheet lenders, so it's like I was confident, and then my partner was like, "They're freaking out." I'm like, "Not my guys." But anyway. But tell me about how it was for you guys and how things kind of evolved during the 6-month process for you guys. When we popped back up in September, I think everyone kind of like stabilized a little bit. Tell me about that period.
Yeah, I mean, initially in March, it was it was concerning for everybody, right? Because nobody knew where it was going to go.
Right. Can we even build anymore?
Exactly. Yeah. Is everything going to stop? But the 6 months after, March 2020, we were really busy. I mean, our phone was ringing off the hook with people saying, hey, my money, whether it was Wall Street money, institutional money has kind of gone away.
The originators were calling you to help.
Yeah. And our investment group, they were fine, right? They were like, okay, well, let's just continue to do deal by deal and cherry pick the ones that we like and just continue on. So it was actually really good for us. I mean, it was a busy time. Not really.
No?
Not really.
That's good.
I mean, maybe a little bit, but not much.
We saw some folks charge a little bit more because I mean, the market can bear it now.
Yeah, right. Absolutely. But that rebounded pretty quickly.
Yeah.
I mean, like you said, it was probably 6 months, and then institutional was kind of back into the space. But what it did was it revealed what happens when things get a little scary.
Right.
Then who's going to be around and who isn't. And when you look at what happened in 2008, like the Great Recession and traditional lending and things got really frothy, obviously. Traditional lenders were lending to high loan to value properties, 100% financing sometimes to borrowers that
you're seeing today.
Not kind of like we're seeing today.
Yeah.
And the end result really was a lot of regulation that happened after 2008, 2009 in the traditional space. And so
Dodd-Frank, 2012.
Right, exactly. Yeah. Right. Yeah.
I remember when the law came out, all of us here were just like, what is this? Well, how what? It's this giant set of rules that impacted everybody.
Right.
If you touched the mortgage, you were now having to go walk through a mile of red tape. It was nuts.
Right. And is the consumer any safer because of it?
I would argue if you are on the true conventional, and 10-20% down, I think so. But if you're dealing with some of this non-QM stuff, or some of this, some of the DSCR stuff that's getting a little frothy, I think that we're starting to see, hints of subprime again. A lot of risk being taken, unnecessary risk being taken, and the borrower is glad to get the deal, but I think they're gonna be able to get themselves out of it while things are hot. If they don't get themselves out of it while things are hot, they're going to be stuck, and that's going to be that bad. That's going to be a bad time. So I mean, agreed with you. Being the big picture. I mean, but let me ask you this though: 'cause we've had this discussion with other lenders of the idea of like avoiding regulation, right? And we should make sure that we're staying conservative to avoid regulation. Other folks have argued that because this industry is so fractured, and because this industry, we have guys who are doing on the same balance sheet, will do, 100-door multifamily, fix and flip, rental loan, construction deal on a mixed use. They'll mix it all together. So from a regulator standpoint, they don't know what to do with us, right? We're so fractured. We do a little bit of everything. Well, that's changing, but still to this day. And, from a regulatory standpoint, if I'm the banker's regulator or if I'm the mortgage regulator, we look like commercial operators. We don't look like consumer lenders. And so that's the argument. Like, hey, you guys aren't touching the consumer, you guys. And I think that's allowed a lot of people to go kind of cowboy and kind of really go hard. And what are your thoughts on, like, the idea of staying commercial and that keeping us out of hot water, that kind of argument? Because people have made that. We don't touch a homeowner, if you will,
Well, that's true, but if the industry sustains a lot of losses, and those losses are investor losses, then the regulators are going to come in. It may not be a homeowner that's in the house because it's traditional, type loan, but if you've got a lot of investors that have lost money.
When you say investors, you're talking about like the people who are investing in real estate and those investors.
Well, the ones that are also investing in the loans.
That's true,
right? Yeah. And so if they sustain a loss, then the regulators are going to probably, at least there's a chance they're going to start to focus and say, hey, look, there's not enough regulation here because there's a lot of private money lenders that were lending 100% loan to value and got, ahead of their skis, even though it was commercial. There's
so would you say then the biggest concern in your mind would be like the types of frameworks that we see in conventional being imposed onto us, like the whole idea of 20% down or PMI or ATR, those kind of things you see in conventional being imposed on us?
That's my concern, right? When there's a shift, will the regulators come out and start to focus a little bit more on our space? I don't
Especially
know.
on the resi side of the business. I mean, we're starting to see that, and we're starting to see concerns of that, in the DSCR sector, right? Do you guys do DSCR, the rental loans? Build to rent is now kind of a thing now, isn't it? Yeah. Okay, so let's switch gears a little bit. I want to talk about, you guys are focused on the Western states, right? Mm-hmm. And construction is one of your biggest kind of like strong suits. But construction is a hot topic right now. A lot of people are complaining about there's not enough construction, right? We need more construction lenders. What have you guys seen so far these days? I mean, is it picking up a little bit? Are we getting more units being built, both in apartments and in homes? Is it happening or is it not? Because I've been hearing a lot of speculation on this, both sides.
Yeah, I mean, I think we are, but if you look at the numbers over the next couple of years, there's still a deficit of housing.
It's
right?
severe, apparently.
It's pretty severe, right? And so 2 to 3 years out, I think we're probably, we're still catching up a little bit. I don't know what happens after that. But I mean, we're seeing a little bit of a slowdown in some markets in terms of just regulatory, like getting the permits through.
It's even slower.
Cities are
even slower, huh?
they're on Zoom or they're not working. It's even slower, right? And it's
California
difficult.
is known to be terrible for getting permits and entitlements. I mean, it's even slower. That's nuts.
Yeah, and we're seeing that. We're seeing, borrowers come to us and they say, hey, this is our plan.
Yeah.
We want the loan. We're going to have a grading permit in the next 30 days.
Right.
And then all of a sudden, it's 6 months later and they still don't have a grading permit.
6 months.
I mean, it can be pretty long, yeah.
Unless you're Toll Brothers or Lennar or something like that. Yeah.
Right.
Yeah.
But if you're a mid-sized builder building 50 homes,
right.
That may not be the case.
Are you guys still seeing kind of the popularity of the master plan? I don't see as many master plans being built anymore. It's not as popular.
Yeah, I mean, I think that they're out there. It's just that, in the populated areas, we're running out of space.
Mm-hmm. Yeah.
And so a lot of the, properties are sort of being picked over. So in the populated areas, the projects are smaller, or they're going out into tertiary markets, around Sacramento and that sort of stuff where there's still a lot of land. Yeah. And they can do larger projects.
Right. Mm-hmm. So so what markets do you guys, what do you guys use to evaluate your markets when you guys are lending? Because it's interesting on construction. I've had this discussion with other lenders who do this. They, evaluating a market to lend in is, to me, I was like, I didn't even think, like a lot of them look at like population demographics, not just density, but demographics. They look at recent shift in school. I mean, what do you guys look at when you guys look at a new market?
Yeah, we look at the demographics. We look at, what's going on in the market. We'll go talk to the city. We'll find out what's been happening in kind of, the different parts of the town. But,
wait, you're talking to the city. So not the local guys who are operating the city.
Yeah, we'll talk to the city
and the
as
zoning
well.
board and those people. Oh, okay.
Yeah.
That's a different way to look at it.
Yeah. And that I used to be on the planning commission and the Carlsbad City Council.
Yeah,
and so I've got that. So I've got that on the other side, and
Right.
that helps kind of for us to understand both sides of the equation.
Right. You understand local politics.
A little bit on the politics side.
Yeah.
So, but one of the things that I think that we all benefit from in this space, if you were here in 2008, 2009, is we've all lived through, for good or bad, we've all lived through the Great Recession of 2008. And so when we look at properties and we look at 2008 against kind of call that the low water mark, what was this property? What were these homes selling for in 2008, 2009?
Okay. Yeah.
And we sort of use that as a metric. Now, I'm not saying that we're going to go back to the prices of 2008, 2009.
Right.
But if you use that as a low watermark, and that's at least some gauge.
Your worst case scenario.
Kind of a worst case. And if we're still okay, our average loan to value on our portfolio is about 50%. So we're pretty low.
Yeah.
We probably could go back to 2008, 2009 numbers and be okay.
Right. Your investors love
not that we want to do that.
But no, that's interesting. So we do have a handful of clients that are known for having their low LTVs. But the challenge with that is that they're going into markets where they know they're solid on valuation. Even they're looking back at 08 numbers, and even in 08 the numbers didn't shift. Maybe a 5%, 10% shift, but because of the values in the neighborhoods. But with today, with the whole Great Migration, people are leaving. What used to be a great place to live, and now they're leaving, right? So, how has that impacted you guys from the value and going into new markets? Because, let me ask you this: are you now considering Tennessee? A lot of people in Southern California move to Tennessee, right? Same with Florida, Texas. Are these markets that you guys are considering now when you're mostly Western United States?
We're not really considering going out to the East Coast. I know the Carolinas are really hot as
Carolinas,
well. Nashville is super hot. Obviously, Austin, Texas,
and they're building
is really hot. Yeah, they're building.
Yeah.
But building. I've done building in Texas as well. Building in Texas is not the same as building in California. Supply and demand are generally in check. In California, if you need 100 homes, if you have a demand for 100 homes, it's gonna take 5 years to go through the planning process and permits and environmental challenges and everything else, right? I mean, maybe that's an exaggeration, but it takes a long time and very expensive. If you're in Texas and you need 100 homes, you go out and Billy Bob's back 40 and you build 100 homes, and within 6 months or 9 months, supply and demand are in check. It's just so much easier to meet the market there, and it's much more responsive. Where in California, the demand builds up.
Hell, in Houston, there's no zoning law, so you can literally build a house next to a gas station. So So you're saying there's a speed in which it's harder for you to compete in these markets, right? Because they can move real fast.
They can move, absolutely fast. But we look at markets like Idaho, and we look at
another popular area to move.
Yeah. Even Wyoming. I mean, Jackson Hole in that area, and even the surrounding, towns around Jackson Hole.
I was just flying out of Vegas, and I've never heard so many flights going to Wyoming and Montana in my life. More flights going to that part of the country. You never used to get a flight to that part of the country. So,
and there are a lot of, you talk about the Great Migration. There's a lot of people out there that are, lived in California or have 1 foot in each. A lot of people. I mean, I've got friends. I'm sure you do too. Right, that are just wholesale. I'm packing my bags and I'm moving out.
Yeah. I mean, to this day, I'm still looking at houses in Plano. Yeah. Plano seems to be the place. My wife's like, if we're going anywhere, it's gonna be Plano because they got a Korean market in Plano. So, we're going there if we're going anywhere. But it's crazy because the whole idea of moving to I've never lived out of the state. I've grew up here, but people are just packing up their bags and moving, and it's still happening. It wasn't a COVID thing. They're still doing it. And the northwestern United States seems to be very popular. Southeastern United States is very popular. Now, in the northwestern part of the United States, you guys are looking at those areas to transact in. Are they building? Are they building new homes? Are they building new, communities? That includes retail and office and whatever you have out there you need to build to actually have a community. Or what are they doing that's attracting you guys?
Yeah, I mean the Portland market is pretty hot, and there's a lot of multifamily going on out there. A lot good sized projects that are really above the size that we would do. Again, we've done deals in those markets, but not really deliberate. So we're gonna start to push out and be a little bit more deliberate in those spaces. But there's definitely a lot of activity out there. The Boise market and
Coeur d'Alene.
Yeah. I mean, there's a lot.
What's the typical kind of transaction you're seeing that come out of this? Is it residential home builders or is it multifamily? What are you guys usually seeing?
We're seeing both.
Both.
Yeah, definitely.
It's all residential related though these days, right?
For the most part, yeah. We've got, we got, we had a deal that we recently got paid back in Seattle. It was, a piece of property right downtown Redmond across from the Microsoft campus. And they were, we just did the land loan for it, right? But I don't know how many $100 million project in order, they're going to build
Sure.
multifamily up there. And so we're seeing a lot, in the urban areas, a lot more density, obviously, similar to what you're seeing in California.
But it's also hard to build out here, isn't it? I mean, I don't know about Seattle. I would imagine Seattle's pretty hard to build as well.
Yeah.
And the process is so different state to state. Like, how are you guys kind of preparing for that? Because it's one thing to do a flip or a refi or something like that, but when you're dealing with construction loans, right, you have to, like you said, like the California build process is so thorough, right? And when you're going into another, like, a different market, but that's a blue state that predictably will have those types of bureaucracies, but different, right? How do you guys plan for that kind of stuff in advance as lenders try to expand into different markets? What are you guys doing to prepare for that?
Mm-hmm. Yeah, so we've got land use people on our team locally that will go out and actually we'll send them out to go look at the property and meet with the city and the county and make sure that we understand what's going on.
And they know what to do when they're speaking with the actual, like the bureaucrats and the politicians, as opposed to just the land itself, right?
Right.
Okay.
Right. Yeah. Okay. And there's nuances, obviously, from state to state, and even city to city. I mean, the city next to this one, it's different, right? Every city handles things differently. Every state handles things differently. But we're not going to go to another state and give an entitlement loan. Mm-hmm. They already have to have that stuff. They basically are going to have to be shovel ready. Okay. So at that point, we're not going to take on a tremendous amount of risk. There's a certain
amount of risk you're willing to take, but that kind of risk is really meant for your backyard.
Right.
Okay. That's fair. I think that's a good way to look at it. It's nice and conservative. You know exactly how you're going to approach it if you're going to take that kind of risk. Yeah. Let me ask you this, though. So now we're talking about kind of whenever I talk about construction and commercial, and one of the things that is a hot topic, it's always been a hot topic in my mind, is cannabis. Right, a lot of our clients do it. A lot of our clients are thinking about not doing it now. This pilot program coming out on the title side. Have you guys done any cannabis deals? What are your thoughts on cannabis?
We haven't, and we don't. Mm-hmm. Not because we have some kind of judgment about it. It's just that we've told our investors that we wouldn't.
Right.
For me, I hear a lot of people talk about, well, I don't want to do it because the feds, it's still on schedule, and that kind of stuff. Sure. I don't really see that as being the case. Right. I mean, it may be an issue. I don't know. But what I have seen is, and we've actually had a borrower that we did not give a loan for, on a property in a Palm Springs area. Yeah. And they, the city council said, hey, we're going to allow, cannabis in this area. And he went and got a loan and bought the property and put cannabis in there. The neighbors came out with pitchforks, right? The community came out and said, we don't like it. There was a lot of pressure, and really then with the same pen that the city council used to say, you can do cannabis in this area, they said, no,
they removed the zoning.
They removed it, and they said, no, it's granted. So as soon as your tenant's out, it's out.
Wow.
And so that's really more of a local regulation thing.
Sure.
That really doesn't show up in the headlines.
I thought it was so popular in all California. I mean, what are your thoughts on this?
That's what I was going to say. Is it's so popular that I look at that as a danger. There's so many people getting into this space. It's going to get overcrowded.
It's already overcrowded.
Right, exactly.
Mm-hmm. And there are public companies lending on this stuff now. Mm-hmm. So
right. So it's hard to know who's going to survive through this and who's going to fall off. So it's a tough market.
Yeah, and it's interesting to me because it's a challenging issue, right? Because that means it's also getting more legitimate to me, right? It's at least the real estate stuff, not the not the loans that touch the plant or the loans that are factoring these guys. Not that type of lending, but the real estate component of it is becoming so much more standardized. And yet, most commercial real estate lenders that I speak with take the same position. It's oversaturated. It's not a risk. It's not a risk issue. It's just not a comfort. It's a comfort issue, right? We're okay. We can underwrite the risk, but we're just not comfortable with it. Not because of federal, right? Because it's just a matter of comfort. But yet, it is going mainstream, and it is becoming, wildly popular with a certain subset, especially folks who are doing construction loans. In the future for Enact, would that be on the table? Let's just say we got federal approval, and the title covered it and everything else like that. We'd be, it's kind of a more traditional asset class. Would be okay with you then? Because industrial, on its face, is a very attractive asset class, mm-hmm. right? So, and a majority of that's being used either for e-commerce or cannabis in California, at least. So, what are your thoughts on that kind of stuff?
Well, and that's mostly what we see. It's not the dispensary, we're seeing the
Yeah.
guys who are wanting to grow.
Yeah, yeah, but also you said you do ag loans, right? And so as things, it's kind of an interesting challenge. Like we always have to follow the market, right? And if this stuff becomes fully legal, right, and you start getting requests for the equivalent of a vineyard, but now it's for a grow operation. I mean, we're headed in that direction, I feel like, you know?
Yeah, I still would have concerns with the oversaturation. And you know that once it becomes federally legal, then the Philip Morrises of the world are going to get into
That's
it.
true.
I've
That's a
heard
good way to
that
look at it.
Heineken is looking to get into it over here at some point out of the Netherlands. So there's a lot of risk there from a business standpoint, even when the regulations allow it, I think.
Put the operator at business.
Yep.
Yeah. We've heard of that happening. A couple clients led into a med here and there, and they couldn't make rent. So, you know, it happens.
Valuations are tough as well. I mean, we've looked at several of the deals. You know, we wouldn't put in our fund for the reasons I mentioned, but you know, some of these buildings that you wouldn't let your dog sleep in, and the valuations they get, you think it was a Class A building, and it's like, well, okay, yeah, if it is that use, but
Green valuation for sure.
right. But if it has to be tomato storage, that's not going to. That's not going to work. It's not going to pay the rent.
The second you install lamps in an advanced HVAC system, now the value is triple. I don't think so.
Right, exactly.
I agree with you there. And there's a lot of frothiness when it comes to those valuations.
Right.
But I think that's also added on the industrial side, right? The popularity of industrial is massive. I've never seen so much industrial go up. I mean, ever. I live in a, close to an industrial area, and it's like, they're just continuously building. They're tearing down and building, and they're repurposing and building more and building more. It's almost as if we're going into a world of just apartments and warehouses. It's crazy. And I mean, talk about that real quick. You know, like, how does underwriting industrial change for you guys? Because it's becoming like the mainstream asset class in commercial, right? And everyone wants to do it.
But I don't think that's new. Like historically, if you look at commercial, like at the basket of commercial, office, industrial, retail, things like that, the performance of industrial has always been the outperformer, right? Compared to those, the other ones.
But with added things today, right? With cold storage and e-commerce, and I mean, it just seems to be just increasing it even further. Right.
Right. Oh yeah. I mean, there's such a huge need for the distribution. It's not only the distribution, but it's like when you return an Amazon package or something like that, you need a place to go take it back to. So,
even these guys who are doing these small eBay businesses and Amazon businesses, they run out of small light industrial warehouse and they operate their business out of that. So it's like, to me, I'm just like, well, this is where we're headed apparently, because retail, it's a sign of retail dying. I guess my point is, right? And you know, how are you guys dealing with that shift in the market? You know, it's mass popularity.
Yeah. Well, I mean, every deal stands on its own, right? The loan to value, the sponsor, the strength of the sponsor. I mean, we see great industrial projects and we see not so great ones. Same with commercial, same with residential. So
I mean, it feels like today any industrial deal is like it's almost bulletproof. It feels like everyone wants it,
but it's expensive. People are paying a premium for sure.
And it depends on the tenant situation too. I mean, I don't know that we would do a spec industrial build, but if there's a solid tenant that they have lined up with a lease or at least an LOI and it feels pretty good, then we would consider that.
Okay. That's good to hear. You're sticking to your guns and being conservative on it because it's challenging. And I view the industrial as very much along the lines of kind of on the resi side for our private lending industry, because both are immensely frothy right now. And you know, people are paying a premium, and they're going after it as hard as they can. I want to switch gears to resi real quick, and then we'll have to shift toward some market condition topics, but. On the resi side, how much are you guys involved in resi? Are you guys doing a lot of construction loans right now on the residential side, or not really that much?
Small.
We'll
do small.
Small percentage?
Yeah.
Okay.
But we'll also do horizontal construction.
On resi.
Which is a little bit somewhat unique, we find. There's
Very unique, actually.
A lot of lenders that will do vertical.
For our listeners, they should listen in. Enact Partners says horizontal on residential.
Yeah.
Yes, but we don't only do horizontal.
But they'll do it. No, but that interesting part is there's not many folks who can do that. They don't know how to underwrite it.
Yeah.
Right? So they're usually going to have to come out of pocket for that kind of stuff, at least the way how I see. So.
Right.
Yeah.
Yeah, and I only mention that because I've seen so many land requests coming in because obviously when we say we do land, everybody's ears perk up. But
and then you get all the garbage.
And then I just get all land deals. But we do everything. So.
Yeah. I mean, you guys are flexible and you guys can do the construction, but you have the skill set to handle the right land deal on residential as well. And so talking about that the how popular construction on resi is right now, and how challenging is it for you guys to say, because resi's on fire, right? Resi is just bonkers, and CRE has had its challenges over the past, I would say, 8 months, right? Especially retail, and it's been a very challenging place, especially for the bigger ticket projects. Talk about, have you guys ever had to have that discussion internally? Like, we're sticking to our guns. We're not jumping into resi, because a lot of folks have, right? And talk about that real quick. I mean, the issue of, I guess it's, for me, looking at the market from where I am, I see a lot of folks transitioned away from commercial, and double down on residential. What are your thoughts on that?
Well, we don't really operate that way. As Michael said, we look at it on a deal by deal basis. So we're not the type to say we're not going to do retail, we're only going to do residential, or anything like that. So
it's just the right deal, you're saying.
Exactly. A deal stands on its own, and if it makes sense and if we feel good about the developer, then we'll do it.
Excuse me. Let me ask you this then. This is an interesting way to look at this. Is how often do you guys say no? Because there's all kinds of deals that are coming out right now, right? It's a lot of, I always call it speculative deals, especially on the build side, right? And so how often are you guys saying no to these applicants and these originators out there?
That's tough to say. I don't know. It's probably half and half.
That's still good. I mean, I always tell people, like, on the show, like, saying no is probably one of the best things you could do in this space.
You got to kiss a lot of frogs in this industry. You really do. You got to look at a lot of deals.
Exactly.
Because they're not going to work out, right?
Yeah.
That's sponsorship.
Being comfortable saying no is important.
Yeah, we say no a lot.
It's not a bad thing to say that.
But we try to do it quickly.
Right.
Right.
What about that Band-Aid?
Right. And when we give a loan, provide a loan to a maybe a construction loan, right, to a borrower that's doing a land development project, generally they're going to be pretty sophisticated. Mm-hmm. But because of our background and the things that that we've done outside of the private lending space, we really do try to be a kind of a partner with them.
Right.
Not in the legal sense, but if we see something, we recently had a situation where we had a borrower that came to us in the city, had inadvertently overcharged them about $300,000, right, for permits that they weren't allowed to do by law. And it was actually our land use consultant that picked up on it. And we went to the borrower and we said, hey, by the way, did you know that they can't do this? And here's the law. And then we put them in contact with an attorney that handles that kind of stuff, and they end up going to the city, and they end up saving over $300,000.
That's so much value add. I mean that borrower must be thinking about, because that could have jeopardized the entire deal. Right?
Yeah, I mean they had it in their budget, so they were already accounting to pay the extra $300,000.
But they were just out of compliance.
But they just didn't have to pay it, so that just went to their bottom line, an extra $300,000. And so, for us, we're very, kind of on a consultative basis. We're not just trying to, here's the loan and it's a commodity and good luck.
Right.
We do have something to offer on the land development side.
Yeah, there's a value add component there that you're not going to see with your traditional construction lender. That's interesting, because with that component, I would imagine then a lot of your business is repeat business.
Mm-hmm.
That's good. Yeah.
And back to the turning down loans side, it depends a lot on the brokers you deal with too. Mm-hmm. So we deal with a lot of great brokers who give us a good package, and they're not going to pass a deal on to us if they know that it's an issue or it's garbage.
Right.
So, the broker and their creating or getting information together, putting it in a package for us, it's huge.
Yeah, and that goes to I guess length of experience, and also understanding. There's a level of underwriting that brokers need to understand how to do, and that goes to hand-holding and being willing to talk with them and show them. And are you guys training new brokers that come your way and say, "This is how we do things at Enact. This is what we want to see from you in the future"? Is that what you guys are doing with the brokers? Like a new broker comes to you,
we have not done that. Most of the time, we don't need to.
Good,
but it's just a lot of asking questions.
Okay, and then they'll pick it up.
And then they pick up that right. We need some more information.
Because that seems to be also an interesting challenge, both with, I speak with a lot of Wall Street aggregators and also, a lot of lenders who are primarily broker driven, and the biggest complaint is like the data sets are awful. Like every time it's a different data set, and training people to give you the right package is a very challenging issue. Cool. Okay, so I want to ask you guys a question because you guys have very interesting backgrounds in real estate, both in commercial and resi. I'm going to ask this for both marketplaces because this is unique to we don't get this opportunity a lot. First on resi, okay? On residential, I always ask this on the show, bullish, bearish the next 3 years in private lending. What are your thoughts?
I'm bullish.
Okay.
In the next, 2 or 3 years.
2 or 3 years.
Yeah, just because I think that the demand is still there,
Right.
and supply is not caught up yet.
Right.
I don't really know beyond that.
Well, who does?
Yeah.
I mean, 3 years is kind of far anyway.
I don't even know what 3 years really.
Right.
But I'm. What do you say?
Yeah, I agree.
I'm bullish on
For
it.
residential.
Yeah. Mm-hmm.
Okay.
Yeah.
Now let's switch gears. Commercial real estate. I just got back from a craft show. Mm-hmm. It was interesting. I've never seen that many bridge. All the agency guys that are normally there didn't show up. A handful of them were there. Mm-hmm. A lot of bridge guys, a lot of construction guys. Not as many agency guys as you'd think. And a lot of the big shops couldn't be found. Right? CBRE wasn't there. Right? So it's interesting. And I was a little bit concerned as I walked away from the show. I was bullish on the bridge stuff.
Right.
And the construction. I don't know. What do you guys think? Multifamily was huge still. I mean, don't get me wrong. Yeah. But that's not,
Yeah, I'm bullish on the construction side, the bridge side. But new product, maybe other than industrial, not so much.
Retail, office.
Yeah.
All the conventional asset classes.
Yeah. Mm-hmm.
What do you think?
Yeah, I agree with that. Feel a lot safer in the residential right now. I mean, everyone has to live somewhere.
Right.
And with what's going on with office, with COVID, and people working from home, and then the retail side too, and it's a lot riskier, and we're a lot more careful when we're underwriting that.
Let me ask you guys this, because you guys are dealing with this on more frequently than most of our guests do. Is I've always wondered why. Well, if it wasn't for zoning, why couldn't we just convert a lot of these offices? Right? You basically just have wire frame buildings. Why can't we convert these things into condos or apartments or industrial, even like light industrial, or like, something else? Because there's so much office out there and no one's going to work anymore. They're just working from home, or they're switching gears and they're going to a smaller location. Like, why can't, are you guys seeing any conversions happening with some of the or hotels, right?
So we have a loan on a property downtown Mammoth.
Okay.
Mammoth. And great property.
Yeah.
Very centrally located. And the developer is converting that office building into, a hotel project.
Okay.
So not multifamily,
but still,
it's a conversion, right?
That makes sense for a ski town.
Yeah.
100%.
Yeah. Adaptive, reuse type project. So we're starting to see that kind of stuff.
Okay.
Yeah.
Good.
We're also seeing some developers who are buying office buildings so they can get them re-entitled for multifamily. Are they being much more understanding with this? Like with California, it's so hard to get permits. Right.
Mm-hmm.
But I'm sure they understand how office is dying. I mean, is that playing a factor, or is it still really slow, really challenging?
Well, in the state of California, the state comes out with these RENA numbers, basically how many residential units you have to each city.
Yeah.
It basically starts with each county has to
Well,
produce.
I've heard about this, and this is partially why we don't have it.
Right, exactly. Yeah. So then the state comes and says to each county, says, hey, these are your allocation. You need to produce 10,000 units over the next 5 years. And they have like basically 5-year bands. Then the counties go to all of their cities and they make allocations and they distribute. They say, hey, this city, that city, whatever, based on your land use, this is what you have to produce in terms of housing. In the past, the state has been a little bit hands-off on it, where they've said, hey, really what you need to do is have land that's able to be zoned for residential, sort of an enabling sort of perspective. But because of the housing shortage, they're becoming a little more aggressive, and they're saying cities, not only do you have to just rezone land that allows, for residential, but you got to start to build. You got to start to have programs in there. You have to streamline your permits. You have to, make it a lot easier.
So the state is demanding it get better.
They are. Okay. However, until
surprising
somebody
for California,
it is. But the
they're
real
not making it any easier though. That's
they're not. But CEQA, California Environmental Act, until there's CEQA reform, it's probably not going to speed up very quickly, right? Because what happens is these developers, they can maybe get through the process quicker at the city level, but then they're met at the end with a CEQA challenge, and then they're tied up in court for 3 years, and now we've got a delay.
Right. Right. We saw that happen in my backyard. We had a wonderful multifamily project, and it just died basically on the vine, and they finally finished it. They finished it like toward the tail end of COVID, but it was sitting there for 2 years. And just like, what the heck's going on? And you started to have homeless people just camping out there on the construction site. It was terrible.
Mm-hmm. Well, and a lot of times the number of units ends up getting reduced because of CEQA. And
use density.
And then so in order to make it pencil, you have to put in luxury units. And then we have this issue of affordable housing.
I've heard about this. Yeah.
And so the state's doing that too. They're coming down on cities who don't have enough affordable housing.
Right.
But it doesn't pencil.
They're going to penalize you for not building enough affordable housing, and they're going to campaign on that. But yet the laws that they put in place make it impossible.
Exactly. Yep.
Thanks, California.
It's a challenge for sure. Yeah.
Well, you know what? I am still optimistic though, because we have we do need more houses here in California, and if we're heading in that direction, at least the motivation is there. Hopefully, they can loosen up the laws a little bit, because I would love to see some of these office buildings and hotels be converted into apartments and condos. I think it'll be great for the communities, and continue us on this bullish cycle on residential too. So,
yeah.
All right.
Absolutely.
All right. I think that's all the time we have for today. This is been a really great one, because we get to talk about California law and California building, and I never get to talk about building things on this show, because we're talking about lending and mortgage industry. But this has been great. We talk about construction and permitting, and thank you guys for joining us on the show today.
Thank you.
And this is Kevin Kim signing off on Lender Lounge. See you guys on the next one. Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Gerasi. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim signing off.